Hello everyone. I hope my screen is visible to you.
Yes, sir.
Yeah, thank you. So, hello everyone. Welcome to the first live session of the corporate finance course. And a brief introduction of mine. I am Sivratan Tiwari, and I am a PhD scholar in the Department of Economic Sciences at IIT Kanpur. And I will be your instructor in the live session for this course. For any queries, you can write to me for related to this course. Okay. And today's session will be mainly introductory. If you have any questions regarding the course structure or grading or any other things, any logistics related to the course, you can ask here. And then we will have a brief recap of week one. And then I will have your comments and suggestions if you have any. So coming to the course structure, like it is a normal course structure of the degree courses. So there will be total 12 weeks material, and each week you will have a assignment, and there will be 20 questions in that. And in the assignments, like we can have like a bit high numerical questions there. But in the quizzes, we will try to have make like the calculations will be bit less harsher in the quizzes so that they can be solved without the calculators also. But in the assignments, you may find some questions which are very highly numerically intensive. And as usual, like the assignments will be like taking 10% of the overall grading, and two quizzes like the first quiz and second quiz you will be knowing the quiz dates by now, and the first quiz will be for 20% and second for 30%, and at the end there will be final exam. I think these grading details and all are available on the course page in the under the introduction of the course.
Yes, sir.
Now, coming to the overall outline of the course, like this is how this course will go. Like in the first week, it was mainly about the introduction, like why we should study finance, why it is important, and the professor go through the example of the global financial crisis which erupted in the United States in 2007 and 8, and that was like knowing about these things like these can help us in better asset management and all. So the first week is mainly about the introduction, and from week two we will start like how we value different types of assets, and then capital budgeting rules, how yield curve or the bond market behaves in week five, like what are the different ways of investment and what is the like the how risk and reward are related to each other. Like in general, we heard this thing like high risk, high reward, or high risk, high return kind of thing. That we will try to analyze through the theory, like how that like to put in place in the theory. And so till week four, we work in an environment where like there is no uncertainty, like all the information is known upfront to you. But in reality, this is not the case. There are future is not known to us. There is uncertainty. So we try to incorporate uncertainty into the theory. And first we start with the basic principles of choice under uncertainty, like how an individual makes decisions under uncertainty, and then we that incorporate that into like the portfolio theory, like if there are multiple assets available to you, then how will you choose the best possible asset, like the composition of assets or the portfolio which will maximize your like the risk reward ratio, like you will get high reward in comparison to this. Then, in the last part of our course, we touch briefly on how foreign exchange market works, like how the exchange rates are related to the general economy, like how the economy performs, how the exchange rates are related to that. And then the later part, like we touch it, like we go through some strategies related to derivatives, mainly the options. So like how these derivatives can be incorporated into our portfolio for the risk management part. And at the end, in the last week, we touch upon some pricing theories like capital asset pricing theory, other pricing model like factor models, arbitrage pricing theory, and we also talk about like the market efficiency, like how we evaluate the efficiency of markets. So this is the brief outline of the course. And coming to week one, in week one, like as I said, like we started our discussion with like what are the main components of the financial markets. Like there are, we hear a lot about like the share market. So share market or the stock market, which we say that is one type of financial instrument. There are other things like bonds. What are bonds? How bonds are traded? How bonds are priced? And another major financial asset is derivative. So derivative is like a financial asset whose value is derived from some another asset. That underlying asset can be anything. And also like other component is the risk, like how risk plays a role in valuing the financial assets. So we gave professor gave a brief introduction about how risk plays a part in this, and further like how trading happens, what are the like the mainly two types of trading strategies are discussed in this introductory lecture. So first is the fundamental value, like you take a asset, financial asset, and you try to assess its fundamental value. Like for example, if you are assessing a share, so for example, State Bank of India share you are assessing. So what you do, like you try to find like what is the fundamental value. How do you do that? You go through its various reports, various financials, like financial statements, and try to assess like whether this State Bank of India company, whether it is performing well or poor, and on the how it is paying its dividends, etc. Like all sort of information that is available. So trader used to gather all the information available about the State Bank of India and try to assess a fundamental value, and then assess like whether the current share price is higher than fundamental value or the lower than fundamental value. And the basic strategy about this is like the price of that share will or that asset will come to the fundamental value of that particular asset. So this is the basic like the rationale behind this strategy. And another main trading strategy is momentum trading strategy, in which what investors do, like they generally don't do such high level fundamental analysis. They just see like what is the trend in this particular asset. For example, the State Bank of India's share price is rising, so they will go through the momentum. They will uh, think like, yes, it is going up, so I should buy now, and it will, when it will be high enough, then I will sell and I will incur a profit. So this type of strategy is momentum. And like the majority of retail investors, mostly they opt to the, if they are in the stock market, they opt to this momentum strategy only, because you at this retail level you don't have all the information available to you. Okay, please stop me whenever you have any doubt or any questions. Please stop me with that. Now further, like there was a brief details about like how market for these financial assets work. Like we discuss about the order book, like how, like on the minute of seconds level, like at every second, for example, how these things are playing a role. So how orders for buying are placed, and how orders for selling are placed, and when these two mates, then a trade happens. So we discussed that also. So and how the price is decided, like when there is a match in like the bid or bid and ask, and then when the trade is matched, trade happens, and that is the price that is recorded at that particular time point. Okay, And next, like there was, so based on this, like there is also a discussion about asset market bubble, and an example of tech bubble in 2000s was given, that was in the US. So what happened, like all the shares which are related to the technology companies like Apple, Microsoft, etc. And there was a tech boom, like everybody was very optimistic about these technology shares, so that like they assumed like these will keep on growing. So these will keep on growing. So everybody was investing in that, but their fundamental value was not that much high. And after a point of time, when this was realized by the investors, and the Nasdaq index, which was composed of technical index, that dropped down. So there was like, this is how asset market bubbles are formed. And when like majority of investors are not opting for this fundamental value trading strategy, then there is higher chances of formation of these types of asset market bubbles. And later on, like there was a huge discussion about 2007 and 8 global financial crisis. Why? Because this is a classic case of like how financial crisis happens. And after after that global financial crisis, many of the measures are now in place, like to prevent from those type of situations happening in near future in the financial markets. So in the lecture, professor discusses like what was the main reason behind this global financial crisis, how this happened, like what was the situation in the housing market of the US. It was on a upward rising trend in the early 2000s, and after the later part, like the prices were rising. And what the financial intermediaries or the banks do, so they what they did, like they combined all these like mortgage loans, the housing loans, into a structured product or a complex product, and they sold this to the investors. And in general, like people think, investors think like because a mortgage loan is for a very long maturity, correct? So they consider it like it will be like mostly it has very low risk. So that's how they composed, like if they combined a combined security and then sold this to the investor, it was considered as like very less risky kind of instrument to invest, asset to invest. And what happened in the global financial crisis, like a lot of mortgage loans were defaulted simultaneously. And that's how all these financial assets which were built on top of these loans, those were also being started defaulting. And why this crisis happened, the major fault was from the credit rating agencies, because they rated these com- complex assets while like the CDOs, like the debt obligations and these structured products, they rated them incorrectly. Why? Because they did not consider the correlation between them correctly. They considered them uncorrelated to each other, but in reality, those have a highly high correlation among them, and that was the main failure from the credit rating agency side. Okay, so this was a major overview of like what happened in 2007 and 8 financial crisis, and what did government do to, like the government introduced a TARP scheme, and they bailed out some of the institutions, some major banks, and they let some of the institutions like the default, etc., etc. These type of things happen. So this was the main thing which was discussed. So the major motive of the week one was to give you a overview of like the what comes under the financial markets and what is its importance. Because when you are like the educated about these financial markets and you are actively investing, then having this information make you like better adjusted to these kind. Whenever such kind of financial crisis happen, you will be well better prepared for this. Okay. So if you have any questions regarding any part of week one lectures, please do let me know. And now I want to put some some emphasis on some of the basics. Like I want to discuss a brief about like what are bonds, what are shares, and what are derivatives. So coming to the bond, like bond is nothing but like it is type of a loan. So for example, when you go to a bank and you take a loan, and what is the loan? Loan is like you take the money upfront and you say like I will pay you like either in the form of EMIs or in the form of a lump sum payment at the end of some particular time. That particular time is called maturity. So in this, when you are going to take a loan, so you are the one who is giving a bond to the bank that you will pay this. But think about a government. So government wants some money to do its day-to-day things. So what it does, like it goes to the public and it says like, you give me money right now, and I will give you this piece of paper or some like the legal document saying that government will pay the holder this much amount at this time, maybe 3 months, 1 year, 10 years, etc., etc. So in exchange for the money at that point of time, government is giving you some like assurance that it will return you after some point of time. So this is bond. So bond is nothing but a loan. Okay. And in the lectures we discuss like how the pricing of bonds is done and how it is related to the interest rate that it is paying. So obviously when you are giving your money right now and in return that you will get your money later in future, you will want more money at that time because obviously you are doing some kind of investment. So that's why there will be more money at the end of. So the amount you give now, you will get amount more than that at the end of the maturity of that bond. And what are the various features for a bond? So for example, like there is a par value or the face value which we say. So for example, if government a bond has a face value of 1 lakh rupees. So what it means, like when the bond matures, you will get 1 lakh rupees. That is the meaning of face value. Coupon, coupon means like there may be intermediate payments also. So for example, a bond says like at maturity it will give you 1 lakh rupees, but for example it is a 1 year bond. So for after every 3 months you will get a 5,000 rupee in form of coupon. So there is 0.5% coupon rate. So coupon rate is decided as a percentage of this face value. Maturity, it is very simple, like at what time this bond matures. So for example, if the final payment happens on after 1 year, so maturity is 1 year. Issuer is like who is issuing the bond. So when you are taking a loan, you are the issuer of the bond. When government is taking loan from the public, government is the issuer. Sometimes companies also issue bonds. So in that case, like that company or that corporation is the issuer of the bond. And what type of issuer is that decides like how risky this bond is. Correct? Because like generally government is to be there like for like will be there, will pay its debt. So most of the time like the government bonds are considered to be like the very less, like there is very less risk in terms of that, because it is almost certain that government will pay off because it will not get out of money when there is a time of pay. But there may be a company which is very vulnerable, then in that case like there will be high risk of default. It may be the case like that when the maturity comes, the company is not financially well, so it is unable to pay that amount to you. So then there is a high risk of default. Like default is nothing but like unable to paying your obligation. correct? So issuer is very important to assess the risk of a bond. And coming to the price, like price is decided like according to the cash flow and the interest rate that is there. So for example, if you think like the interest rate in the market is 10%, and like one after 1 year a zero coupon bond, like there is no intermediate payment, and 1 year the bond is going to pay you like the 1 lakh rupees, so the face value is 1 lakh. So you can simply calculate the price, like what should be the price today for this kind of bond. Okay, and in practice, like when we do our economic analysis, we consider like 3 month treasury bills as risk-free securities, because we consider like government is not going to go away in the coming 3 months. That is the basic assumption behind that. So that's why we consider 3 month treasury bills or the government bond. Whatever rate is there, we consider that as risk-free rate, like for for our economic analysis. And we will see later in the course like why this risk-free rate is important in our case. So this was the bonds. So if you have any queries related to bonds, please do let me know, like any type of questions if you have. Okay. Now coming to the stocks or shares. So these are different from bonds. So here you are not like loaning the money, like not giving the money to get it back at some future time. But here you are giving money to get like the claim a part of that asset. Like for example, if you are buying the shares of a company, then you are kind of buying the claim on that particular company. Okay, for example, for State Bank of India company, if there are like, let's suppose there are 10 lakh shares that are there. So if you hold one share of that State Bank of India, then it means like you have a claim on 1 over 10 lakh times part of the assets of that company. Okay. And whatever profits that State Bank of India will be going to make, then that will be like distributed according to the whatever amount of shares I am holding. If I am holding the State Bank of India shares, so let's suppose State Bank of India makes 100 lakh rupees of profits and there are 10 lakh outstanding. So per share, this profit will be 10 rupees. Now this profit may be like given to the shareholders, or maybe it will be held back in order to expand the business, etc., etc. So it all depends on the management of the company. But this is how like the valuation of for the shares means in real life. So coming to the features, so there is no promised stream of payments and there is no maturity. So maturity is nothing. So if you have a share today, you will have like you can have this share until the end of that company. So until unless that company is there, the share is valid. And the stream of payments, so you can say like shares pay dividends, but that is not specific. A stock can pay a dividend or it may not pay a dividend. It is up to the company management to decide that. And both these things like the bonds and stocks, both of these are like means of raising money. So in the bonds we see like the if a company issues a bond, so what it takes the money and then issues a bond, so it is like raising money or financing the company. In stocks also, like companies saying like I will give you this much proportion of my company in order to, if you give me this much money. That is what shares are. So both of these things are like means of raising money. And coming to the third major type of financial asset, which is derivatives. So what is a derivative? So derivative is like a financial instrument whose value is determined by some other underlying asset. So for example, that underlying base asset may be a stock, maybe a bond, maybe any other thing, any other economic thing. Like, and nowadays there are many options which are like the weather derivatives. Weather derivatives means like depending on the what will be the weather or what will be the temperature, on those type of things also there are derivatives are issued. And major like the use of these derivatives is to risk management. So this is used for manage the risk. So for example, if you are holding a shares, holding a stock of a company, and if you want to hedge this risk, or like if you want to take keep some other thing, so that like if the stock price goes down, then like you can minimize your risk of that thing. So in that case you may use these derivative products, and we will have a extensive discussion of this when we discuss the basic option theory, like how we can use derivatives for hedging the risk. Okay, so I wanted to give you a brief emphasis on these bonds and stocks. Like if you have any like the questions on these things, like please do let me know.
Sir, I have a very basic query, not
Yes.
related to this course. What I want to ask is, after we complete this course, we be able to share trade shares and all those things? We will be able to do that.
I am not sure of that, but I like you will understand understand the basics of this, like what is happening in the stock market. You will be able to understand those kinds of things.
And we
But
will be able to understand why it's happening.
yes, you may find the one of the reason will be related to the theory. So for example, let's suppose you do not find any major changes in a company's like no major changes recently in a company,
Hmm.
but you see the prices stock prices rising, then you can relate it to like the momentum strategy kind of thing is working here, and it may be going to a bubble or that kind of thing. Like you will be able to relate the reality to like some of the theories which we are going to learn in this course.
Okay. Thank you so much, sir.
Yeah. And coming to like the key learnings which we learned in the first week, like the first is a very basic thing, like high risk high return kind of thing, which we like emphasize in the first week. And other thing is like whenever we value or price in financial asset, so there are two things related to this. One is like how risky this is, and what are the expected cash flows, like what is the money I am going to get through this financial asset. These are the two key things which play a role in the determining the value of a financial asset. Okay, so for example, there was an example in the lectures, like when the default risk is high, then the issuer has to like the ensure a higher rate of interest so that the investor is attracted to buy that bond. Correct. Another thing which we learned is like there are mainly two types of risk. One is the idiosyncratic and systematic. So what idiosyncratic means, like it is related to that particular company or that particular project, that kind of thing. So there is no role of other things. Okay, it is completely related to that particular company. Whereas the systematic is like it is like the throughout the system. For example, it is throughout the financial market. So in 2007-8, it was a systemic risk that was happening because all of the markets were falling down simultaneously. Or in other words, like whenever there is a like the economy wide fluctuation happening, that is a type of example of the systematic risk. Okay, or when something like the related to a particular company happens. So for example, there is a change in the board of a company, so like the managing director is placing down or the CEO is replacing someone else, something like this happen, that is like the particular to that particular to that company. So that is type of idiosyncratic risk. And the one thing which we learned is like this idiosyncratic risk is diversifiable. What we mean by this? So think about yourself as an investor, okay, and you consider a particular company more risky and other less risky, correct? So you have both of these available as an investment vehicle, like you can invest in any of them. So what you will do, like you will choose the companies which are less risky, and you will avoid the companies which are more risky. So in that way you can diversify that risk, like you can avoid that risk. But when there is a systematic risk, you cannot avoid that, because whichever instrument you are going to choose, that is like that risk is going to be there in your portfolio. That is why this statement is there. And one basic principle, like if you are going for a fundamental analysis of a particular asset, so if you are able to do your analysis and you achieve to a point like you find the fundamental value of asset, then one simple basic rule is that like you buy the underpriced asset and you sell the overpriced asset. And in the future lectures or future weeks, we will going to learn a, some of the valuation models, and through that you can like the find out like whether this particular asset is underpriced or overpriced. But this principle will always work, like if the asset is underpriced, like currently price is low but actual price should be higher according to the model, then you buy that and sell the overpriced one. And other thing like related to the global financial crisis, like whenever there is a structured finance asset like the complex product like CDOs or SIVs, etc., etc., they always this correlation between financial asset is very crucial for like the evaluating those financial assets. Like for example, if you are not about a structured finance asset, but think about any type of like the assets. For example, you are going to buy shares of two particular companies, and if these two companies are very correlated, so for example, if you choose two companies from the same industry, you choose Punjab National Bank and State Bank of India. So there is very high chances like when State Bank of India goes down, and PNB will also go down. Why? Because there may be a like the issue in the overall banking sector. Maybe government brings a new scheme or the new regulation on the banks, and that like that makes their prices to fluctuate. So if that happens, like there also you should always consider this correlation between two assets whenever you are making your portfolio. So it is always better to choose like the assets which are very less correlated to each other. Then there will be high like the benefits from the diversification, because your portfolio is well diversified. So these are the kind of things which you are going to learn in the later later lectures. So like why this correlation matters, there will be, I think in week 3 or 4 we discuss this thing in a full length, like how this plays a role. Okay, so these are the things which we learned. And if you have any, so I have already discussed in the outline section, so we are going to look at these topics in the coming future. And if you have any other questions related to course or week 1 material, or if you have any suggestions like what you would like to be covered in these live sessions, please do let me know, like I will try my best to incorporate all those things in coming time. Thank you. Okay, so if you don't have any questions, so if you have any suggestions like how these live sessions should go in the future, so in the week one there was not much content. In from coming weeks, like there will be numerical problems there, like the numerical examples will be there. So if you have anything in particular you would like me to cover, please do let me know.
Sir, is it important to know about economic crisis in 2007, 2000?
So it is not important, but like it gives you a motivation why you should like learn about these things. It is
Yes,
not compulsory, but you should know like what happened. And so I think there is a movie also. I don't remember the name, but
Mhm.
yeah, if you want to understand, you can watch that, and that will give you better understanding about like what happened in 2007 and 8. Also recently in COVID-19 time also, like COVID-19 was like a shock kind of thing that come outside the financial industry, but still there was disruptions in the market. So that also is a very good case study to like see like what happened during COVID-19.
Okay, sir. Because I couldn't able to understand the lectures, there some terms because you using while explaining the slides. Uh, that's why.
Yes, yes, I understand. Like there was a lot of economic and financial terminal terminology was used,
Yes,
but
sir.
I think as the professor said, like this is what this is what it was in the introduction. So it is fine if you don't understand each and every word, but you
Okay.
should get a sense like what happened in 2007 and 8. That
Hmm.
much is fine, but from coming starting from week 2, like we will start from the very basic, like, and we will start building all these terminologies and how and where this should be used.
Okay.
Okay,
Okay.
from week 1 like you can leave like I also understand like these are very complex terms.
Yes, sir.
So if you are new to finance, this is very complex. So it is fine
Yes.
if you don't understand each of them.
Okay. So
Okay.
actually, who is rating these bonds like a AAA, AA, and what is this AAA, AA rating is?
So there are credit rating agencies like there is one S&P, there is Moody's, and Fitch. These are three major global credit rating agencies, and they rate each type of bond which is there in the market. Okay, and
Okay.
what these ratings mean, like there is a different a scale like triple A, double A plus. These type of ratings are there, and this means like this is according to the how much risk is there in the bond, according to how much is the risk of default for that particular bond. So triple A bond is the least risky. There is very minute chances of default, like it is kind of like it is not never going to default. So if you see the bonds issued by the government of United States, those are most of the times are rated AAA. That means like those bonds are never going to be defaulted. And as the rating goes down, the risk of defaulting goes up. And according to that, the prices in the market are like for these bonds are there in the market.
Okay.
Yeah.
From which time this kind of rating is provided for bonds? Any
Sorry.
starting?
Yeah.
Any starting?
Whenever a bond is issued, a rating is given to that bond.
No, at
So
which year this kind of rating is provided for the bonds?
So for every like whenever a bond is issued, like for example, a 10-year bond is issued by the government of India, let's suppose. So till the time when this bond is active in the market, so let's suppose it is issued today and it is going to expire after 10 years, let's suppose in 2035. So the rating of this bond will be available throughout this time period.
Okay, okay, sir.
and it may go down and up according to the situation of the issuer, that is Government of India. So if government is stable, then it will be, its rating would be good, and if there is some instability is there in the economy or from the government side, then this rating may go up or down. Okay.
Okay, sir.
Okay, any other questions if you have?
Yes, sir. Can we get the slides that you were
Yeah,
sharing?
yeah, these live session slides will be shared by the team, like
Okay.
maybe in like 1 or 2 days, but it will be shared with you.
Okay, okay. Sir, and there was some numerical questions also.
Hmm.
Uh, I could able to solve that questions, but I can't understand the question, sir.
So those questions are like when there is like like the practice problems you are saying now,
Mm-hmm. Yes, sir.
like the that professor said, like so those questions are mainly for the purpose of those are like to understand like the what play this correlation played in those structured finance products. So you
Okay.
see, like when there is no correlation, what
Mm-hmm.
was the valuation of those, like those products, like the senior trends, junior trends, and mezzanine trends, and when there is perfect correlation, like among the assets, among the bonds, then what
Mm-hmm.
was the valuation among them? So that was the main reason, like the how these things play a role, how correlation plays a role in valuation of these products.
Okay, okay, sir.
Okay, so
Yes, sir.
thank you everyone. See you all next week and have a
Thank
great
you, sir.
learning experience throughout the course.
Thank you, sir.
Thank you.